The Dow theory evolved from the work of Charles H. Dow, which was published in a series of the Wall Street Journal's editorials between 1900 and 1902. Dow used the behavior of the stock market as a barometer of business conditions rather than as a basis for forecasting stock prices themselves. His successor, William Peter Hamilton, further developed Dow's principles and organized them into something approaching the theory as we know it today. These principles were outlined rather loosely in Hamilton's book, The Stock Market Barometer, published in 1922. It was not until Robert Rhea published Dow Theory in 1932 that a more complete and formalized account of the principles finally became available. The theory assumes that the majority of stocks follow the underlying trend of market and most of the time. The theory assumes that the majority of stocks follow the underlying trends of the market most of the time. In order to measure the market, Dow constructed two indexes, which are now called the Dow Jones Industrial Average, which was originally a combination of 12 but now includes 30 blue chip stocks, and the Dow Jones Rail Average, comprising 12 railroad stocks. Since the rail average was intended as a proxy of transportation stocks, the evolution of aviation and other forms of transportation has necessitated modifying the old rail average in order to incorporate additions to this industry. Consequently, the name of this index has been changed to transportation average. Interpreting the theory. In order to interpret the theory correctly, it is necessary to have a record of the daily closing prices of the two averages and the total of daily transactions on the New York Stock Exchange (NYSE). The six basic tenets of the theory are discussed in the following sections. Number 1. The averages discount everything. Changes in the daily closing price reflects the aggregate adjustment and emotions of all stock market participants, both current and potential. Changes in daily closing prices reflect the aggregate judgment and emotions of all stock market participants, both current and potential. It is therefore assumed that this process discounts everything known and predictable that can affect the demand supply relationship of stocks. Although acts of God are obviously unpredictable, their occurrence is quickly appraised and their implications are discounted. The market has three movements. Number two, the market has three movements. There are simultaneously three movements in the stock market. Footnote 1. This assumes that the averages were available in 1897. Actually, Dow theory was first published in 1900. And footnote 2. It is important to use closing prices since intraday fluctuations are more subject to manipulation. Primary movement. The most important is the primary or major trend, more generally known as bull or bear market. Such movements last from less than 1 year to several years. A primary bear market is a long decline interrupted by important rallies. It begins as the hopes on which the stocks first purchased are abandoned. The second phase evolves as the level of the business activity and the profit decline. In the third stage, the bear market reaches a climax where stocks are liquidated regardless of their underlying value bracket start because of the depressed state of the news or because of forced liquidation caused, for example, by margin calls bracket closed. A primary bull market is a broad upward movement, normally averaging at least 18 months, which is interrupted by secondary reactions. The bull market begins when the averages have discounted the worst possible news and confidence about the future begins to revive. The second stage of the bull market is the response of equities to known improvements in business conditions, while the third and final phase evolves from overconfidence and speculation when stocks are advanced on projections that usually prove to be unfounded. Secondary reactions. A secondary or intermediate reaction is defined as an important decline in a bull market or advance in a bear market, usually lasting from 3 weeks to as many months, during which interval the movement generally retraces from 33 to 66% of the primary price change since the termination of the last preceding secondary reaction. Reference to footnote 3. This relationship is shown in figure 3.1. Occasionally, a secondary reaction can retrace the whole of the previous primary movement, but normally the move falls in the one half to two-third area, often at 50% mark. As discussed in greater detail later, the correct differentiation between the first leg of a new primary trend and a secondary movement within the existing trend provides Dow theorists with their most difficult problem. Minor movements. The minor movement lasts from 1 week to up to to a week or two up to as long as 6 weeks. It is important only in that it forms part of the primary or secondary moves. It has no forecasting value for long-term investors. This is especially important since short-term movements can be manipulated to some extent, unlike the secondary or primary trends. Reference to footnote 3, Robert Trier, Dow Theory, Barron's, New York, 1932, figure 3.1, secondary retracements. Point number 3, lines indicate movement. Rhea defined line as a price movement 2 or 3 weeks or longer, during which period the price variation of both averages moves within a range of approximately 5% of the mean average. I see no reason why the 5% rule cannot be exceeded. After all, it really represents a digestion of gains or losses or a pause in the trend. Such a movement indicates either accumulation bracket start stock moving into strong and knowledgeable hands and therefore bullish, or distribution bracket start stock moving into weak hands and therefore bearish brackets close. Reference to footnote number 4. An advance above the limits of the line indicates accumulation and predicts higher prices and vice versa. When a line occurs in the middle of a primary advance, it is really forming a horizontal secondary movement and should be treated as such. My own view is that the formation of legitimate line should probably take longer than 2 to 3 weeks. My own view is that the formation of a legitimate line should probably take longer than 2 to 3 weeks. After all, a line is really a substitute for an intermediate price trend, and 2 to 3 weeks is the time for a short term or minor price movement. Number 4, price volume relationship. Provide background. The normal relationship is for volume to expand on the rallies and contract on declines. The normal relationship is for volume to expand on rallies and contract on declines. If it becomes dull on a price advance and expands on decline, this is a warning that the prevailing trend may soon be reversed. If it becomes dull on a price advance and expands on a decline, this is a warning that the prevailing trend may soon be reversed. This principle should be used as background information only, since the conclusive evidence of trend reversal can be given only by the price of the respective average. Number 5, price action determines the trend. Bullish indicators are given when successive rallies penetrate peaks while the trough of an intervening decline is above the preceding trough. Conversely, bearish indicators come from series of declining peaks and troughs. Figure 3.2 shows a theoretical bull trend interrupted by secondary reaction. In example A, the index makes a series of three peaks and troughs, which each higher than its respective predecessor. The index rallies the following the third decline but is unable to surpass its third peak. The next decline takes the average below its low point, confirming a bear market as it does so at point X. In example B, following the third peak in the bull market, a bear market is indicated as the average falls below the previous secondary trough. Following in example B, following the third peak in the bull market, a bear market is indicated as the average falls below the previous secondary true. In this instance, figure 3.2, primary trend reversal. In this instance, the preceding secondary was part of the bull market and not the first row in the bear market, as shown in example A. Many Dow theorists do not consider penetration at point X in example B to be a sufficient indication of a bear market. They prefer to take a more conservative position by waiting for a rally and subsequent penetration of that previous row marked as point Y in example B. In such a case, it is wise to approach the interpretation with additional caution. If a bearish indication is given from the volume pattern and a clearly identifiable speculative stage for the bull market has already materialized, it is probably safe to assume that the bearish indication is valid. In the absence of such characteristics, it is wiser to give the bull market the benefit of doubt and adopt a more conservative position. Remember, technical analysis is the art of identifying trend reversals based on the weight of evidence. Dow theory is one piece of evidence, so if four or five other indicators are pointing to trend reversal, it is usually a good idea to treat the half signal at point X as an indication that the trend has reversed. Example C and D represent similar instances at the bottom of the bear market. The examples in figure 3.3 show how the primary reversal would appear if the average had formed a line at its peak or trough. The importance of being able to distinguish between a valid secondary correction and the first leg of new primary trend is now evident. This is perhaps the most difficult part of the theory to interpret and unquestionably the most critical. It is essential to establish that the secondary reaction has retraced at least one third of the ground of preceding primary movement as measured from the termination of the preceding secondary. The secondary should also extend for at least 3 to 4 weeks. Figure 3.3, lines being formed at peak and trough. Vital clues can also be obtained from volume characteristics and from an assessment of the maturity of the prevailing primary trend. The odds of a major reversal are much greater if the market has undergone its third phase, characterized by speculation and false hopes during the primary upswings, or a bout of persistent liquidation and widespread pessimism during a major decline. A change in the primary trend can occur without a clearly identifiable third phase, but generally such reversals prove to be relatively short lived. On the other hand, the largest primary swings usually develop when the characteristic of a third phase are especially marked during the preceding primary movement. The largest primary swings usually develop when the characteristics of a third phase are especially marked during the preceding primary movement. Hence, the excessive bouts of speculation in 1919, 1929, 1968, and 2000 in the Nasdaq were followed by particularly sharp setbacks. Intermediate term movements are discussed more extensively in Chapter 4. Quite often, a reversal in an 18-month rate of charge from a reading in excess of 200% is reflective of such an exhaustion of buying power. Quite often, a reversal in an 18-month rate of change from a reading in excess of 200% is reflective of such an exhaustion of buying power.